Hey everyone, and welcome back for another deep dive.
Yeah.
Today we're looking at something that, well, let's face it, we should probably all be thinking about a little more.
Saving.
Saving. Yeah.
Yeah,
Specifically long-term savings. We all know it's important.
absolutely.
But, well, it can be kind of confusing, right? Figuring out where to even
I
start.
hear that a lot.
Yeah. So we've got a great article here from The Balance, and we're going to break it down, see what we can learn, and hopefully get some, actionable advice.
Perfect.
Because I know I struggle with this personally, like, you're saving for a rainy day. You've got your emergency fund.
Right.
But then, like, what about those big goals,
Mm.
down the road? Retirement, maybe a down payment on a house.
Yeah, a lot of people hit that point and then kind of stall out. They've got that emergency fund, but haven't really thought about those longer term plans.
Exactly. That's me.
Yeah.
So maybe you can, like, break it down for us. What are we even talking about when we say long-term savings accounts?
So these are accounts specifically designed to help you reach those goals that are, well, months or years away. They're not for your everyday spending or that unexpected car repair. We're talking about harnessing the power of something called compound interest.
Okay, compound interest. I've heard that term, but I'll be honest, I don't really get what makes it so special.
I think a lot of people feel that way. It's like this. Instead of just earning interest on the money you initially put in, you're also earning interest on the interest you've already made. So it really starts to snowball over time.
Okay. I'm intrigued, but can you give me a real-world example? Help me wrap my brain around this.
Sure. Imagine you put $1,000 into an account with a, let's say, 5% interest rate.
Okay, got it. 5%.
After a year, you'd earn $50 in interest.
Makes sense.
Now, in year two, you're not just earning interest on that original 1,000, you're earning it on $1,050.
Ah, so the interest is building on itself.
Exactly, and it just keeps compounding year after year.
Okay, I'm starting to see why people get so excited about this compound interest thing.
It's pretty powerful.
All right, so if compound interest is the engine, what are the vehicles? What kinds of long-term savings accounts are out there?
Well, let's start with one you've probably heard of, the high-yield savings account.
Oh, yeah, high yield. Sounds good.
It can be, but it's important to make sure it's the right fit.
So what's the catch? Like, what's the trade-off for that high annual percentage yield, or APY as you financial folks call it?
You always got to read the fine print, right? A high APY is great, but it's got to be from a reputable source.
Good point. Where do you even find these accounts?
You'll see a lot of them offered by online banks.
Online banks. See, now that makes me a little nervous. What about, security?
I understand that concern, but most reputable online banks are FDIC insured, just like your brick and mortar banks.
Okay, so my money's still protected.
Yep. Up to $250,000 per depositor per insured bank.
Good to know. Good to know. So high yield savings accounts, those seem good for, like, shorter term goals, right?
Yeah, I'd say so. Maybe a few years out.
What about if we're talking like 5 years or even, further down the line?
That's when you might look into certificates of deposit or CDs.
CDs?
Yeah. So with a CD, you basically agree to keep your money in the account for a certain amount of time.
Like a savings lockbox.
Kind of. And in exchange for that commitment, the bank gives you a guaranteed interest rate.
Sounds good. But there's got to be a catch, right? There always is.
You got it. The trade-off is flexibility.
Ah, I knew it.
If you need that money before the maturity date, you usually face a penalty.
So you really got to be sure you won't need to touch that money for a while.
Exactly. But, there are ways to be strategic with CDs, like laddering.
Laddering, what's that?
So you basically spread your savings across multiple CDs with different maturity dates.
Ah, I see.
It gives you some predictable returns, but also some liquidity if you need a chunk of your money sooner.
Okay, that's pretty clever. But let's be real. The big one for a lot of us is retirement.
The big kahuna.
Yeah. I feel like that's where things get really confusing. IRAs, 401ks.
A lot of jargon, yeah.
Where do we even begin?
Let's break it down. How about we start with IRAs, individual retirement accounts?
Okay, individual retirement accounts. Sounds manageable. What are the basics?
Well, there are two main types, traditional and Roth.
Okay, 2 to keep track of.
With a traditional IRA, your contributions might be tax deductible.
Ooh, tax deductions. I like the sound of that.
Right. It can potentially lower your tax bill now.
So what about this Roth IRA? How's that different?
With a Roth, you're contributing after-tax dollars. But here's the kicker. Your qualified withdrawals in retirement are tax-free.
Whoa, wait a minute. Tax-free in retirement.
Exactly.
Okay, that's a game changer. I'm definitely going to have to dig deeper into the pros and cons of both. So IRAs, those are for us regular folks saving on our own.
Yeah.
What about those employer-sponsored plans?
Right. Those typically called 401k, although some companies might call them something slightly different.
Okay, 401k. And what's the big deal with those?
The real magic there is the employer match.
The match.
Yeah, a lot of companies will match a portion of your contributions.
Wait, so they're basically giving me free money?
Pretty much. You put in a percentage of your pre-tax income, and they match a certain percentage up to a limit.
Okay, I'm listening. Tell me more about this free money situation.
It's a fantastic way to supercharge your retirement savings, especially if your company has a generous match.
That sounds amazing. Are there any downsides to 401ks? I mean, there has to be some catch, right?
Well, similar to traditional IRAs, you'll pay taxes on those withdrawals in retirement.
Ah, right. Okay.
And you usually can't withdraw that money before retirement age without a penalty.
Retirement age.
Okay.
Which is like,
Usually 59 and a half.
got it. So upfront tax break, potential free money from my employer, but I got to wait till I'm almost 60 to touch it without getting penalized.
Okay. It's all about planning for the future.
Makes sense. But speaking of planning, you mentioned something earlier about investing within these accounts, and that's where I start to get lost. Stocks, bonds, mutual funds. What does it all mean?
Yes, the world of investments.
Yeah, that's where my head starts to spin. Can you demystify all that for me?
Of course. Think of it this way. IRAs and 401ks aren't just accounts where your money sits idle. They give you the opportunity to invest your savings, potentially helping them grow faster than a traditional savings account. Now, stocks are like little pieces of ownership in a company. When you buy a stock, you're essentially buying a tiny slice of that company.
So like I become a mini owner.
Exactly. And as the company grows and hopefully becomes more profitable, the value of your stock should increase.
Okay, so my investment grows along with the company. Makes sense.
Hmm.
But I've always heard that stocks are risky. What about those bonds you mentioned? Are they a safer bet?
Bonds are a bit different. They're more like loans that you make to a government or corporation. You're lending them money for a set period, and they pay you interest in return.
Ah, so I'm the lender in this case.
That's right. And bonds are generally considered less risky than stocks, but they typically offer lower returns.
Okay, less risk, less reward. That makes sense. But I have to admit, I still find mutual funds a bit mysterious.
Mutual funds are basically a basket of different investments.
A basket.
Yeah, think of it like a pre-made portfolio. You're pooling your money with other investors to buy a mix of stocks, bonds, or maybe even both.
So it's like instant diversification.
You got it. Mutual funds can be a great way to get started with investing, especially if you're not comfortable picking individual stocks or bonds yourself.
That does sound a lot less intimidating. So to recap, we've got stocks for potential growth, bonds for stability, and mutual funds for diversification. It seems like there's something for everyone.
Exactly. And the beauty of it is that you can adjust your investment mix within your IRA or 401k based on your individual goals and risk tolerance.
Right, because everyone's situation is different. Speaking of which, you mentioned earlier that those retirement accounts aren't just about saving, they're about investing. How do I even know what the right investments are for me?
That's where it gets a little more personal. It depends on a few things: your risk tolerance, your time horizon, and your overall financial goals.
Okay, risk tolerance. So how much risk am I comfortable with? I guess that's a pretty individual thing.
It is. Think about it this way. How comfortable are you with the ups and downs of the market? Some people are fine with a bit of a roller coaster ride. Others prefer a smoother journey.
I think I'm somewhere in the middle. Okay with some risk, but, I don't want to be losing sleep over every dip in the market.
That's where your time horizon comes in. The longer you have until you need to access your savings, the more risk you can typically afford to take. You've got more time to recover from any potential losses.
Right, makes sense. The closer I am to retirement, the less risk I probably want to take.
Exactly. And then, of course, there are your financial goals. Are you just saving for retirement, or are you also thinking about, say, buying a house or paying for your kids' education?
Actually, speaking of education, that is a big one for me. Are there specific accounts for that?
You bet. Education savings accounts, or ESAs, are designed specifically for those education expenses.
Okay, ESAs. It seems like there's a special account for everything. What's the deal with those?
Well, the most common type is the 529 plan. You contribute money that grows tax-deferred, and when you withdraw it for qualified education expenses, like tuition or fees, it's tax-free.
Tax-free! Music to my ears. So are all ESAs the same?
There's also the Coverdell Education Savings Account, which gives you a little more flexibility in terms of investments, but it has lower contribution limits.
Ah, so there's always a trade-off.
Always. But the key is to do your research and find the option that best fits your needs.
This is all really helpful, but let's shift gears a bit. We've talked about the different accounts, the investment options, but what about some practical tips for actually maximizing those savings, no matter what account I choose?
That's a great question. One of the best things you can do is to shop around. Don't just settle for the first account you come across. Compare interest rates and APYs from different institutions.
So it's like shopping for the best deal, but instead of saving money, I'm earning more. I like that.
Exactly. And if you're thinking about CDs, pay close attention to those maturity dates and early withdrawal penalties.
Right. You don't want to get hit with those fees.
And speaking of fees and penalties, we touched on this earlier, but it's really important to avoid dipping into those retirement accounts before you hit retirement age.
Yeah, you mentioned that. What's the big deal about withdrawing early, besides maybe missing out on some growth?
Well, you could face a 10% tax penalty on top of your regular income taxes.
Ouch, 10%. That's a serious chunk of change.
It is. So it's crucial to have other saving strategies in place for those unexpected expenses or short-term needs.
Right. Emergency fund, things like that. Keep those retirement savings safe and sound.
Exactly. And don't forget, life happens. Things change. It's a good idea to regularly revisit your savings goals and make adjustments as needed.
So don't just set it and forget it. Stay engaged with my finances.
Exactly. And remember, even small, consistent contributions can make a big difference over time, especially with the magic of compound interest working in your favor.
I'm definitely starting to see the power of that. Okay, this has been so helpful. I feel like I'm actually starting to get a handle on this whole long-term savings thing.
That's great to hear. It's a journey, not a sprint. Just keep learning, keep saving, and you'll be well on your way to reaching your financial goals.
A journey, not a sprint. I like that. It takes the pressure off, you know?
Exactly. It's about making those consistent efforts over time, no matter how small they might seem. Even a few dollars a week can add up.
Yeah, it's all about building those good habits, right? Like you were saying, automating those savings can really make a difference.
Absolutely. Take the thinking out of it, set it up once, and let it run in the background. And, speaking of habits, let's not forget about budgeting.
Ooh, budgeting. My least favorite word. But, okay, I know it's important. Any tips for making it, less painful?
Well, it doesn't have to be a chore. Start by tracking your spending for a month or two. Just get a sense of where your money's actually going.
Okay, track first, then budget. Got it. Anything else?
Once you've got a good handle on your spending, create a budget that aligns with your goals, both short-term and long-term. Prioritize those savings goals and allocate your funds accordingly.
So it's like a roadmap for my money.
Exactly. Having a plan keeps you focused and helps you resist those impulse purchases.
You know, it's funny, we've been talking about all these different accounts and strategies, but it really boils down to being mindful and intentional with our money, doesn't it?
Absolutely. It's about making conscious choices that align with your values and your vision for the future.
Well said. Okay, this deep dive has been incredibly insightful. I feel much more equipped to tackle my own long-term savings goals.
That's fantastic to hear. Remember, knowledge is power.
Any final words of wisdom for our listeners before we wrap things up?
Just this. Saving is a journey, and there will be bumps along the way. Don't get discouraged if you hit a snag or two. Just keep learning, keep adjusting, and keep moving forward.
I love that. Keep moving forward. Perfect note to end on. Thanks for joining me today and sharing your expertise.
It's been my pleasure.
And to all our listeners out there, happy saving. Remember, your financial future is in your hands. Start small, stay consistent, and watch those savings grow. Until next time, keep diving deep.